Time to see what Brian Madden's, what's on the radar for Brian Madden. We see Brian Madden right there as the Chief Investment Officer at First Avenue. There he is, First Avenue Investment Counsel. Brian, what's on your radar for the start of the year?
Well, a couple of stocks we can talk about. We've owned them in one or the other or both. In the case of the second one, equity mandates at First Avenue Investment Counsel for some time. I think they're timely coming into 2026. So the first one is TFI International. So this is a large truckload, less than truckload, an asset-light logistics company. Very lean operating philosophy, very strong, long-entrenched executive team, efficient and scale-sized operator with a big footprint on both sides of the border, and a history of being a serial acquirer and consolidator of the very, very fragmented trucking industry. I think they've done something like 80 acquisitions over the last 10 or 12 years. You look at the chart and you say, well, what happened? And so, it's not the case that the company lost its mojo, so to speak, but it's facing the same headwinds that all transport and trucking companies are facing for the last 3 years, which is a manufacturing recession. The ISM manufacturing indices, with little exception, have been below 50 for just about 3 years. And so trucking companies describe a freight recession where there's excess capacity and not much pricing power. We believe that after a string of 4 quarterly earnings disappointments that started in late 2024 and which drew the shares down, which you can see on the chart there, something like 35+%, its fourth largest drawdown in 25+ years of public trading, that they're set up for some easy earnings comparisons in the year ahead. And we may see manufacturing and freight start to turn the corner as some of these older trucks age out and come off the road. This is a stock that since the turn of the century is up in total return terms 17,800%. Wow. So that is really a proof point that the management team is competent and problems when they arise do get fixed. They took steps to do that, changing out one of the senior leaders of a division last March. We're starting to see the benefits with 2 consecutive back-to-back earnings beats. You see it in the chart perking up. This stock is trading at a 24% valuation discount to its U.S. trucking peers at a time where it's poised to grow its earnings at a compound rate of 24% over the coming 3 years. So we see very much blue skies ahead for this trucking company.
And even with everything that's the downtime that they've been struggling through, they've been doing M&As too, right?
Yeah, that's right. I mean, they bought Dasiki in late 2024, I want to say, and they've done a few tuck-in acquisitions. Although more recently, they have been quite adamant that the best use of their surplus capital, and they're still very free cash flow generative even in sort of the down part of the trucking cycle, they're buying back their own shares. They think the highest internal rate of return is buying back their own shares. They're just that discounted, and so they've been doing it in pretty good size in recent quarters. So until such time as they see the shares approaching some semblance of fair value, you can expect them to continue to do that. And then, thereafter, the evergreen sort of strategy of acquiring smaller competitors will probably, reassert itself.
And with this industry, imagine what goes up must come down. What goes down must come up, because eventually demand is there for the things that people need, right?
It's wildly cyclical. So, people buy goods. We know this. They over-purchase goods in all likelihood during COVID because they couldn't consume services. And then, that pulled demand forward, and that's what was the proximate catalyst for this trucking and freight recession. But trucking is just about as purely speaking a commodity as you can get. Like, you need a widget from A to B. Doesn't matter if it's on a blue truck or a green truck or a shiny one or an old one. So it's all about price. And so when there's too many trucks chasing too little freight, the rate per mile goes down and it depresses the whole industry's profits. But when demand comes back, the rates go back up and you get the operating leverage, and you can get some powerful thrust behind a company's earnings like this one.
All right, let's get to the second one. We only got a minute. We talked a little too long there. Exxon Mobil all ties in with Venezuela. Fernando Valenzuela is what I was thinking, who I think was actually from Venezuela. Venezuela and Exxon Mobil.
Yeah, so fortunately they're not operating in Venezuela, but they are very much a formidable and large global integrated oil and gas company. Most of the business is in upstream exploration and production. I want to say 70 or 75% of their operating profit, of which about 2/3 is generated from oil production, about 1/3 from gas, both conventional and liquefied natural gas. They also have downstream integration. There's a big refining footprint, particularly large on the US Gulf Coast, but also in Europe and Asia and other places. They operate 21 refineries. And then they're even further integrated downstream into petrochemical plants. Again, big footprint on the US Gulf Coast. The nice thing, Roger, about owning an integrated oil company is when oil prices are cyclically depressed as they are now, trading in the high 50s, they're sort of partially hedged naturally because the crude oil is a feedstock or an input cost to the refining operations. So what they lose on the sale of the barrel, they might make back on the refining margins, selling the diesel and jet fuel and gasoline and so on. Also, big dividend grower, been growing the dividend for 41 years, and massive share buybacks, 25+ billion a year. So we see a good re-rating and total shareholder return prospect for this company in the coming year here.